Okay, so let's get the show move on. It's been a very tough time on Market Street. The stock market has been a topsy-turvy since 2019 started, so it's been quite tough. So fund managers, stockbroking firms and other market institutions are beginning to feel the heat of the market downturn. On the other side of the street, you have the fixed income space, where yields have trended much lower recently until the last few sessions, where some of the short to medium term treasuries are heading back at double digit, very strong double digits there, 12 to 14%. So how are the markets, firms surviving, and banks as well, with the new readings on food import FX ban by the central bank, taking all that from the top of Mr. President himself? Let's talk to guests at the Nigeria Stock Exchange, is the head of research at FSL Securities by the name Victor Chair. So this is analyst Market Squawk. Good morning, Victor. It's good to have you here.
Morning, Bosun.
Great. Thank you so much for finding time to come here, joining us from our studios there. So the first question is, times are hard. The stock market has not been in its best element since the new year started. So how are market firms like yourself, your colleagues, what are your survival strategies at this time? How difficult are things out there on Market Street?
Yeah, Bosun, the truth is things are really, really tough out there. It takes more or less astute investors to actually understand that this is actually a time to be investing as against time to be actually exiting the market. Over time, you need to take a decision. You either see this as a crisis or you see it as an opportunity. And if you understand that the market actually revolves in circles, you should understand that this is actually an opportunity against being a crisis. So it's time to actually take advantage of this crisis situation so that you can benefit over the long term. But for individual performance, in terms of month-to-month performance for most of these businesses, especially the business and the sector which we actually play in, it's quite tough because a lot of investors are actually moving with the crowd. Once there's a general exit, you tend to find out the market mood is that everybody wants to exit the market. Once there's a bearish sentiment, and the entire market wants to come back once there's a bullish sentiment. But like I said, for astute investors, this is not a crisis. This is an opportunity to make more money.
Yes, on the side of investors, but on the side of trading firms, trading institutions, asset managers, and others, fund managers, how tough are you folks feeling the market's sluggish position?
It's really tough. It's really tough. You hardly find any investment bank or stockbroking firm that will tell you that they're really blasting their targets in recent time with the way the market is. But like I've said, the market revolves in circles, so you need to understand where to be in times like this. Despite not seeing daily gains in the market, it doesn't mean that the market doesn't pose opportunities. So you need to know where your investment funding needs to be going into, especially for players like us and those that have the dealer license where you have to trade on your own fund. So it's pretty tough, but I think for those that understand the business of trading in the equities market, I think we'll find a way around it, and in the end, we'll smile to the bank.
Yeah, the key question is, what questions are investors asking you, Victor? What questions are they asking? What bothers them? What do they want to see? I know they want returns, but what are they worried about, the way things are?
I think the major questions that you get to hear from investors and the general market is what exactly is the catalyst? What exactly is going to change market sentiment from this bearish trend to a bullish trend? Because we've seen some decent numbers hit the market. Yes, we've seen the market react to these numbers positively, but it looks like this rally is not likely going to be sustained for the long term. So the biggest question you're hearing is that where exactly is the catalyst going to come from that's going to drive the market up? If you recall, over the last about 6 months or 5 months ago, we saw yields dropping and we saw interest rates dropping. The CBN had a hand in trying to drop force rates down, and we saw yields in the bond market drop to about 12%. We saw stop rate at the Treasury bill market drop to about 11.18% for the 364 days. But up until recently, we've seen rates also reverse. And dropping rates is actually good for the market, because once yields are lower, you begin to see a slight interest reverse back to the market. But looking at what's been happening in the global space, it looks like the entire world is easing to more or less avert a global recession. But on the contrary, the Nigerian space, we're seeing further tightening. So it boils down to the fact that economists here has a lot of structural issues that needs to be taken care of before we might actually see a rebound in the market. So it's pretty tough, and it's hard to see where the catalyst is going to come from, given all these negative headwinds that we're facing currently.
Okay, so when earnings start coming out from big companies on our markets, especially in particular the banks, everybody's ears seem to be tickled when, in particular, the tier one banks, just a few of them. So what have you been reading in between the lines? As they say, the devil is in the details, as it were. Beyond the headline grabbers, at least we've got three of the tier one lenders, FBNH, GT Bank, and Zenith Bank yesterday on Market Street. What are you seeing in the numbers?
Yeah, if you look at the general perspective of the numbers that have come in, yes, some analysts have predicted interim dividend for the top two tier one banks, which is GT and Zenith, and they didn't fail to deliver 30 kobo interim dividend as expected. But if you look at their numbers, you notice that they tend to be struggling in some of their line items. If you look at their interest income dipped for the three banks: First Bank, Zenith Bank about 6.3%, GT about 7%. Interest expense, yes, for the likes of GT, they were able to reduce interest expense by about 25%. The likes of Zenith reduced interest expense for about 3%. But you notice that is their core business line, and that business line seems to be shrinking for the tier one banks, and they've been able to actually cushion that effect by growing trading income and growing other income, also growing fee and commission income. The likes of First Bank grew fee and commission income. The likes of Zenith grew fee and commission income with about 33%. The likes of GT grew fee and commission income with about 29%. So it shows you that they are looking at other areas to actually grow income. But if you go down to the bottom line, you also find out that they're also struggling to grow their profits. Profits for GT, if you look at in terms of the half year, it just grew not so impressively. And if you look at Zenith, it also didn't grow so well. For likes of Zenith, they had half year. For half year, we saw an effective tax rate which was lower at 20% as against 23%, which aided their profit after tax growth to 8% as against 4% PBT growth rate. So you begin to find out that the banks seem to be strongly and are cushioning this weak interest income earnings by their other income and fee and commission income. But the risk to this is that if you look at the balance sheet, you see that for most of them, their loan book hasn't been growing as well as it should, especially given the fact that we have a new circular, the loan to deposit ratio that should kick in from the 30th of September, where you should have a minimum of 60%. If you look at First Bank has a loan to deposit ratio of about 53% for half year. Zenith has about 51%, while GT has about 49.9%. So these banks actually have a long way to go to meet up with that 60%. How they are going to do this is what we need to actually watch. And if you look at this, you realize that impairment charge for the two banks that actually increased, the impairment charge for Zenith Bank increased by about 40%, while impairment charge for Zenith Bank for GT increased for about 14, while Zenith increased about 44. So that is quite significant. So we need to be wary, despite us trying to meet the loan to deposit ratio of 60%. So we might actually be seeing more impairment charge rise over the long term if we don't actually nip this in the bud as quick as possible.
Yes, Victor, I'm not too sure if things are going to get worse before they get any better, but we don't want to scare anyone here about the outlook we have. Look at the IFRS 9 and the compliance and the costs in particular to our institutions here. Do you see this as another head-scratching issue there as we move down to full compliance? Everyone is getting ready for that as well.
Yes, definitely. We expect that to hit their balance sheet, the income statement line significantly, because as we're beginning to see full compliance, and you recall, the IFRS 9 is more or less a model for expected credit loss, meaning once your loan book increases, you need to provide for possible expected credit loss, which we see impairment charge, right? So that is a very, very critical side to this discussion. So the banks need to really be careful. And if you look at their income line in terms of reduction in interest income and being cushioned by the fee and commission income, there's also a risk there, because when you see the tier 1 banks cushioning net profits by fee and commission income, you recall that MTN currently had the super agent banking license granted by the CBN, and they've actually applied for the payment service license. So if that is granted by the CBN, we might actually see a significant reduction in fee and commission income by the banks, and that might actually pose a much further danger to their net profits. So overall, I think looking at the loan-to-deposit ratio, looking at the expected credit loss model and IFRS 9 in full implementation, I think we might see the CBN actually soften a bit in terms of either shifting the deadline for this loan-to-deposit ratio implementation of September 30th to actually adjust for most of these issues that are popping up, because we don't want a financial system that's going to be crowded with issues. So I think we might need to trade carefully in that space.
I agree with you. Something has to give, because for the banks, the first recourse to safety or safe haven is to hide behind or under the umbrella of the central bank. So that's what should happen. So I agree with you. Perhaps the central bank would need to soften a little bit on some of these issues, or maybe go back to the drawing board and see how the banks can be given some leeway. Now we have the central bank chief yesterday says the FX restrictions on food imports will not just be through the vault of the central bank, but also through the banking system. That's expanding what Mr. President spoke about there. You see this as something that the banks by this morning or since yesterday afternoon will be head-scratching about how much they would lose on this particular front, because if you're talking about sourcing FX for imports for big companies, the banks are play a major role.
Definitely, Bosun. The banks play, in fact, they are the major players in that space because you need to go through the bank to access most of these foreign exchange transactions. So the new statement by the Emefiele yesterday, it's more or less brings a more dynamic aspect to this issue, because the banks are already being squeezed. They are going to be lending in an economy where activity is actually slow. More or less, the possibility of default is actually increasing. We've also seen competition, likes of MTN coming into the space, and that might be reducing income from fee and commission income. We've seen them also reduce their standing deposit facility, as you recall, about some months back, to 2 billion from about 7.5. So it shows you that areas where the banks should be making money is actually coming under some serious scrutiny, and the ability for them to find a way around this would actually might actually determine the big boys from the ones that are not ready to do the business. But if we look at with regard to this policy, yes, of restricting access to foreign exchange from the banks, I think the bank's income would also shrink in that aspect, meaning the transactions that they could have done and make some form of commission on, that aspect has also more or less been closed. So for the banks, it's going to be tough. I think right now it looks like everything that's looking in front of you are all headwinds. There's no tailwinds to actually push the banking players upfront. But I think overall, any bank or most banks that can come out of this, I think they will have a lot of headway to actually make good returns on their investment over the long term.
Victor Chazo from FSL Securities, thank you so much for your time. We appreciate your insight and a perspective on some of the big news we're tracking for our viewers here and around the world. Thank you so much. Do have a great day. Head of Research at FSL Securities. So it's been a tough time as far as the global trade conflict is concerned. So the United States says some Chinese products will have the new tariff hit delayed till about December. That was a few days ago. That was last week. Then overnight, the news that Huawei is getting a 90-day reprieve from the U.S. is also on the street. So is Washington blinking as far as the trade fight is concerned with the Chinese? This is part of the questions I'm putting through to Juliana Olayinka, who is my colleague at our London studio. She's back on the block this morning. Good morning, Juliana.
Good morning, both, and nice to see you. Nice to be back.
Great to have you. Thank you so much. So, first, few days ago, it was the extension to December for some Chinese products to come under the tariff. Then Huawei now gets a 90-day extension, or reprieve, as it were. Is Washington reconsidering the trade fight here?
Potentially. On Friday, it was Reuters that first reported that it was looking likely that Huawei would get an extension on their 3-month reprieval for the ban. And Donald Trump was very quick to put this down. He was speaking to reporters on Sunday, and he reiterated that he did not want to do business with Huawei, that he doesn't trust them, that they violated the sanctions with Iran, that they're using spyware to spy on the Washington government. And within 24 hours, Wilbur Ross, the Commerce Secretary, he confirmed that, yes, there will be a reprieval, that it will be an extension from this ban. So they're getting an extra 3 months, Huawei, with US firms, with the likes of Google and others. And that's likely to expire on September the 1st. But look, you know, it's been very, very difficult. Of course, Donald Trump getting into a spat with one of the world's largest economies isn't just affecting Washington, it's affecting the entire world. Of course, we know that Donald Trump has been trying to put on more pressure on the US Fed. He tweeted yesterday that he wanted Jerome Powell to ease fiscal again. And I think he's just realizing that this fight cannot be personal. It does affect the entire world. So yes, it does look like he is stepping back. Maybe not him personally, but maybe those around him are advising him that he needs to take a step back. We've got that G7 meeting coming up over the weekend. And of course, he's been trying to get into a spat with lots of European leaders as well. So, you know, trying to retrieve on what's going on with China may put him in good firms when he's looking to talk to the likes of Merkel and Macron towards the end of this week. Okay.
Juliana, we've got to leave it there for this morning. Retail sales numbers will be out later today. I'm sure that's very important for those of you who've done a lot of shopping for summer, and summer is almost getting over. So get ready for that with an afternoon show. Thank you so much, Juliana Olayinka out of London. Let's take a break, everyone. We'll be right back in 2 minutes.